Okay. Dear colleagues, dear guests, what an absolute pleasure it is to welcome you to today's event, which will present to you the new study by the EU Tax Observatory on the presence of European banks in tax havens. My name is Nicolaides, and I'm coordinating the research work of the observatory. As a way of introduction, allow me to say just a few words about this relatively new research institute. The observatory is an independent research center tasked with conducting innovative studies on taxation issues, and especially we focus on tax evasion and tax avoidance. We aim to promote democratic, inclusive, and pluralistic debate on taxation matters by fostering democratic dialogue between the scientific community, civil society, and policymakers around the world and in Europe in particular. I'm certain that today's event serves this purpose, conducting innovative research on one hand, while fostering dialogue on the other hand. The Tax Observatory is supported by a consortium of institutions, is hosted at the Paris School of Economics, and receives funding by the European Union. At this point, I should point to the usual disclaimers that the work that you will see today, as all of our work, reflects the opinions of our researchers and of the observatory, and not the views of the European Commission. So since the last June, when the observatory was launched, we published firstly a study on estimating the tax deficit revenues that will be collected by European countries when a minimum tax rate is introduced. This study was published just before the recent agreement of for a global minimum tax rate at the OECD and G20 levels. Secondly, following this agreement last July, we released a note on the effects of carve-outs that were included in the final statement. The note estimates the loss of revenue that will occur if carve-outs are included as part of the deal, and we point out what revenue could be lost for countries in the EU. Today, we publish a new study on the presence of banks in tax havens, which describes how certain jurisdictions have been used by banks from 2014 to 2020. This study also calculates the tax deficit revenues that European countries should expect to collect when a minimum tax rate is introduced. The report will be presented by two of the authors, Manon Barake and Giulia Aliprandi, who are both postdoctoral researchers at the Tax Observatory. A panel discussion will follow after the presentation. So without further ado, let me pass the floor to Mona and Giulia for presenting the report. And I wish everyone a fruitful discussion. Thank you very much.
Hello, everyone, and thank you, Panos, for the great introduction, and thanks to everyone again for tuning in. So as just said, today I will present with my colleague Mona Barake the last report that we've just written together with our colleague Paul Emmanuel. As Panos just said, in this report, we investigate the presence of banks in tax havens and its evolution over time. The idea of this project, I will share my slides here. The idea of this project comes from the ongoing debate on tax avoidance by multinationals, where the main evidence was brought to the public by the academic literature, leaked data, and numerous press articles. And bringing this to the attention of the public was one of the drivers behind the discussions we currently have in the OECD for a reform of the corporate tax system and the introduction of a minimum tax rate. More in particular, and more related to the study we are presenting today, there is recent empirical research on the use of tax haven and the profit shifting activities of banks. And in this context, with this report, we use country by country data to answer the following questions. We investigate to which extent banks use tax havens, how this behavior has changed over time, and by how much European countries could gain from the introduction of a minimum effective tax rate. Our key findings are the following. First, we see that European banks use tax havens significantly, and this behavior at the aggregate level is persistent over time, with 40% of the aggregate profits booked there annually. Further to this, there is some heterogeneity across banks, with the top percentage booked in tax haven being very high at 58%, but ranging from 0 to over 50%. In this context, we also calculate how much a minimum tax could bring to European countries. And for example, with a 25% minimum tax rate, taking in, as for example, the sample of banks that we analyze, around 10 to 13 billion euros in additional taxes annually could be raised by European countries. Going a bit more in the details of our report, what we are going to show you today is first our data and our methodology and some aggregate trends across banks that I will present myself. And I will then leave the floor to Mona that will guide you through our findings concerning heterogeneity across banks and the computation of the tax deficit. Starting from the data and the methodology, the data that we use mainly consists of the country-by-country reports that banks are obliged to file since the implementation in 2013 of the first European Capital Requirements Directive, and most particularly Article 89, where banks and financial institutions are required to report on country-by-country basis several financial variables, and in particular turnover, number of employees, profits, tax, and public subsidies received. Of these banks, we collect information on 36 systematically important banks headquartered across 11 European countries. So our sample includes the largest banks out there, and the data was hand collected for a period going from 2014 to 2020. Overall, these banks are active across more than 130 jurisdictions, and our sample includes over 6,000 information points. And here I take the occasion to underline the great contribution by Mona and Pone Manuel in the data collection, because this data is very challenging to find, and not only is challenging to find, it's also challenging to put together in a single data set. So here, having our data, the second element we need for the analysis is a list of tax havens. As you know, out there are many different lists, but for this study, we decide to identify these countries empirically using two criteria. We use first profit per employee, where we aim to capture those jurisdictions where there are low substantial activities in proportion to profits. And here we take the top 20% jurisdictions in terms of profit per employee. And then on top of this, we have a second criteria, which is the effective tax rate, that allows us to measure the extent to which profits in a defined jurisdiction are taxed. So crossing these two criteria, we come up with a list of 17 countries that, of course, by definition, have very high profit per employee together with a low effective tax rate. Now that we have our list and of course the data set, we can turn to the analysis of the data and explore how the presence of banks in these tax havens changed over time. So to do this, we start exploring some aggregate trends where we pull together and sum data of all the banks included in the sample together and divide by 3 different country groups. As you can see in the chart here, we have in red the tax havens as just described. In light blue, we have the domestic jurisdictions, and in dark blue, we have those foreign jurisdictions that are not included in our list of tax haven countries. So here I want to draw your attention on 2 main things. First of all, the presence of banks in these tax havens is quite high, and over the years they book around 20 billion euros in these countries, which account for 14% of the overall profits that we record in the sample. On top of this, the pattern is constant over the years, and we don't see particular changes. We then bring this a step forward and we compare the profit distribution with the distribution of employees. And here in the first 2 group of columns, you can see the average percentage of total employees and the average percentage of total profits for domestic and foreign non-havens jurisdiction. You can see that in these 2 cases, the percentage of employees is always higher than the percentage of profits, while the opposite is true for tax haven jurisdictions, where the 4% of total employees is reported, but a much higher percentage of profits is recorded there, reaching 14%, as mentioned before. Also, in this case, the patterns are constant over time. I will then conclude this part of the presentation with 2 last slides where we focus our attention on the trends over time of profitability and effective taxation across this different group of countries. Of course, from what we have seen before and our definition of tax havens, you can imagine that the profitability is going to be very high in tax haven countries and lower in the domestic and foreign non-haven jurisdiction. But what I want to draw your attention particularly to is the consistency of this pattern over time. And in tax havens, we have around 300,000 euros per employee as compared to a much lower value of 63,000 euros in domestic and other foreign markets. We can observe similar dynamics for the effective tax rates, where in tax havens country, the effective tax rate is much lower, of course, by construction, and higher in domestic and foreign non-haven countries. And once again, this pattern is persistent over time. So I conclude here this first part of the presentation, and I leave the floor to Mona for the second part, touching upon the heterogeneity across banks and the computation of the tax deficit.
Thank you, Giulia. So we'll continue. I'll just share my slides. Here it is. So Giulia presented to us the macro or the general trend that we get from the European banks in our sample, and we're going to move now to check by bank the trends. So in Giulia's presentation, we saw that the average effective tax rate of the European banks in our sample is around 20%. However, when we go deeper bank by bank, we can see that the effective tax rates are very different according to which bank we are looking at. So the effective tax rates will range from around 10% to 30%, depending on which bank we are looking at, with the exception of Monte dei Paschi, which had a lot of losses, and we are not considering really this its low ATR. So there are 7 banks in our sample that have an effective tax rate that is lower than 15%. And we have only 5 banks that have an effective tax rate that is higher than 25%. The same goes for the profits, so the profits before tax. So when we were looking with Giulia at the macro trends, we saw that that around 14% of the profits of these banks are booked in tax havens. However, when we go as well into this micro level sample, we see that the percentage of profits in tax havens will vary across the banks and will range from 0% for 5 banks which are not present in tax havens, and this can go up to 58% for HSBC. And for HSBC, this is driven by its historical presence in Hong Kong. So we also saw with Giulia that the trend of the profits booked in tax havens are stable over time. So the 14% was stable across our period of time, 2014 until 2020. If we go and check each of these banks, we can see that actually 8 banks increased their presence in tax havens by an average of 6 percentage points. 7 banks stayed, had a stable presence in tax havens. There are 5 that have no presence in tax havens, and there were 16 banks that decreased their presence in tax havens by an average of 7 percentage points. So it's like almost 50%, like less than 50% decreased, and the others either increased or stayed stable, or they were not present in tax havens. Another interesting thing to look at, so we saw as well with Giulia that the profitability by employees of banks is extremely high in tax havens. And when we go deeper into the data, we can see, for example, so here we took just the cases of 3 banks. We have HSBC, Deutsche Bank, and Société Générale. And when we look at HSBC, for example, in Hong Kong, the blue column is the employees and the violet one is the profits. So we see that, for example, in the different tax haven countries, there's a mismatch between the number of employees and the profits that are made. So here we can see for Hong Kong, there's very little employees with respect to the profits. For China, India, and Mexico, the profits seem to be aligned with the employees. The same for Deutsche Bank, where there's a lot of employees and it seems to be okay with the profits. But for Luxembourg, very little employees and with respect to these profits that are made. The same for Société Générale, for Luxembourg, Hong Kong, very little employees, even for the UK. And for the other non-havens, we can see that the number of employees seem to be, okay with the profits. So this was for our description of the trends on the per bank. So after we saw that the ETRs seem to be sometimes lower than 15%, and that also around 25% of the profits of banks are booked in low tax countries that have an effective tax rate less than 15%, we can move to check what happens if the global minimum tax rate is applied on the sample of our banks. So just to give you a hint about this global minimum tax rate that I'm sure that you heard about, it's so first there's pillar 1 and pillar 2. So pillar 1 is not the banks are going to be excluded from pillar 1, and pillar 2 is this global minimum tax rate, which seemed to be until now it seemed to be going to apply with a 15% tax rate. The tax deficit, or this minimum tax rate, consists of considering multinational and taxing its affiliate on the difference of this 15%. So if the affiliate, let's say, have an effective tax rate of 10%, they will have to pay the difference up to 15%. So it will be 5% to the headquarter country. So the country, the parent country here in our case of the bank. So what this would generate? So with a 15% minimum tax rate, this would generate for the 36 banks in our sample around 3 to 5 billion euros to the respective parent countries of the banks, which is between 10 to 18% of the corporate income taxes paid by these banks. Of course, the more we go higher with this minimum tax rate, the more that the parent countries can collect revenues. So with the 21% minimum tax rate, this will go up to between 6 to 9 billion euros, which is around 15 to 35% of the corporate income taxes collected by these banks. And when we pass to a 25% minimum tax rate, this would generate between 10 to 13 billion euros, which is between 25 to 49%. Just keep in mind that these numbers do not take into consideration the carve-outs that might also be applied in the proposition of the minimum tax rate, which will decrease a bit these revenues. So who are the headquarters or the parent countries that would benefit the most? The first one is the UK, which has the biggest and the largest banks. So the UK would collect annually, this will range between around 1 billion to 1.5 billion, or 23 to 36% of the corporate income taxes paid by these British banks that we have in our sample. France also will be the second largest country to collect revenues, which will range between around 500 million per year, or 4 to 9% of the corporate income taxes. There's also Germany, Spain, and Italy that also would benefit, but to a lesser extent. So in conclusion, in our study, we take the country by country report of banks, and we try to describe the trends on a macro and a bank level. We find that the bank's profits in tax havens seem to be stable over time, with around 14%. The banks, however, are heterogeneous, and some are more tax aggressive than the others. The different profitability ratios that we have that are very high in tax havens suggest that either the bank is somehow involved in tax planning for its own benefit, or that the banks are just profiting from the high activities of other multinationals or wealthy people in tax havens. Of course, more transparency is needed towards the activity of banks through the country-by-country reporting in order for us to distinguish the different behavior of banks in tax havens. And so if a minimum tax rate is applied, this would most probably discourage the bank's use of the low tax countries and tax havens, because this would decrease the incentives to go to a low tax country. And so a 15% minimum tax rate would generate 3 to 5 billion euros, as we just mentioned. And of course, these revenues could increase for the parent country the more the minimum tax rate increases. Thank you for your attention, and hopefully we'll get your questions after the panelist discussion. Thank you.
So thank you very much, Manon.